Imagine it's March 2020. You're a 53-year-old elementary school teacher in Columbus, Ohio. For 26 years, you've done everything right. You've contributed 6% of every paycheck to your 401k. Your employer matches half. You've never touched the money. You've never tried to time the market. You've never picked individual stocks. You followed the advice. You bought the index fund, the one everyone said was safe, the one the books told you would guarantee your retirement. The one Jack Bogle promised would let ordinary people build wealth like the rich. And for 26 years, it worked. You watched your balance climb from $12,000 to $400,000. Then, in 11 trading days, $94,000 disappear. You don't sell. You know you're not supposed to sell, so you hold. The market recovers. By December, your balance is higher than before. You exhale. You tell yourself the system works, but something bothers you. A question that never fully forms. If everyone is buying the same thing at the same time for the same reason, what happens when everyone needs to sell? This isn't theory, it's arithmetic. And the answer is something the financial industry does not want you to understand. Here's what you've been told about index funds. They're cheap, they're diversified, they beat most active managers over time, and they're the smartest thing an ordinary person can do with their money. All of that is technically true. Here's what you haven't been told. Index funds were designed to operate on the margins of a market dominated by active investors. They were never designed to become the market itself. And yet, that's exactly what has happened. As of 2024, passive investment strategies control more than 50% of all U.S. equity fund assets. The three largest index fund managers, BlackRock, Vanguard, and State Street, collectively manage over $22 trillion, more than the gross domestic product of the United States. These three firms are now the largest shareholders in nearly 90% of companies in the S&P 500, not through conspiracy, through the automatic, systematic behavior of 300 million people doing exactly what they were told. The mechanism that was supposed to democratize wealth has instead created the most concentrated financial power structure in human history. This is not an accusation. This is simply what the data shows. The pattern is already in motion. In 1975, John Bogle founded Vanguard and launched the first index fund available to retail investors. His idea was simple. Most professional money managers cannot beat the market over the long term. After fees, the majority of actively managed funds underperform a simple index that tracks the market as a whole, and the data supported him. Over 10, 15, 20-year periods, somewhere between 70 and 90% of actively managed funds failed to beat their benchmark. Investors were paying 2% fees for worse performance than they could have gotten for nearly free. Bogle's solution was elegant. Instead of trying to beat the market, just own the market. Buy every stock in the index in proportion to its size and hold it forever. Don't research, don't predict, don't trade. He structured Vanguard as a mutual company owned by its own funds. The profits went back to investors as lower fees. Year after year, active managers found themselves mathematically unable to compete. By the time Bogle died in 2019, he was celebrated as a folk hero, the man who gave ordinary Americans access to wealth building. And in many ways, that story is true. But stories are not systems. And systems have consequences that stories cannot contain. To understand what index funds have become, you have to understand a single mathematical truth. An index fund buys stocks in proportion to their market capitalization. The bigger the company, the more of it the fund buys. Apple is worth $3 trillion. A small industrial company is worth $3 billion. The index fund buys 1,000 times more Apple. This seems logical. You're just reflecting the market as it exists. But here's the feedback loop no one explained to you. When money flows into an index fund, that money must be allocated according to the index weights. The fund automatically buys more of whatever is already the biggest, which pushes those prices higher, which increases their market cap, which means the next dollar buys even more of the winners. When money flows out, the opposite happens. The biggest holdings get sold the most. Price pressure compounds downward. In a world where index funds are marginal, 5 or 10% of the market, this feedback loop is a rounding error. Active investors dominate price discovery. They analyze balance sheets, project earnings, debate valuations. But we no longer live in that world. When passive strategies control half the market, the feedback loop is no longer noise. It becomes signal. The buying creates the conditions that justify the buying. Between 2010 and 2020, money flowed into passive funds at roughly $300 billion per year. Every day, index funds bought the biggest stocks. Every day, the biggest stocks got bigger. During that decade, the top 5 companies in the S&P 500 went from representing roughly 10% of the index to nearly 25%. Was that concentration because those companies were fundamentally worth more? Or was it because the structure of index investing automatically amplified their growth? The honest answer is, we don't know, because we have never run this experiment before. The concentration problem is structural, but it's not the deepest issue. When you buy a share of stock, You're not just buying exposure to profits. You're buying a vote. Every share carries voting rights. Who sits on the board? How executives are paid? Whether the company merges with a competitor. Now ask yourself, who votes the shares held by index funds? You might think that you do. After all, you bought the fund. But that's not how it works. When you buy shares in a Vanguard or BlackRock index fund, you don't receive voting rights for the underlying companies. Those rights are exercised by the fund manager, by their internal stewardship teams, small groups of people you've never heard of, making decisions about the corporate governance of nearly every major company in America. As of 2023, the Big Three collectively cast approximately 25% of votes in shareholder meetings at S&P 500 companies. They almost never vote against management. They almost always support the board's recommendations. But that's not because they don't have power. It's because their power is so large that even the threat of it changes behavior. Corporate executives know that BlackRock, Vanguard, and State Street own massive stakes in their companies. So executives anticipate their preferences. They adapt their behavior to avoid conflict. They call BlackRock's stewardship team before making major decisions. This is not illegal. It's simply the rational response to concentrated power. But here's where it gets more complicated. BlackRock, Vanguard, and State Street don't just own shares in one airline. They own major stakes in every airline. They don't own one bank. They own every bank. When the same three shareholders are the largest owners of competing companies in the same industry, what happens to competition? This is not without precedent. In the late 19th century, a small group of financiers, J.P. Morgan, John D. Rockefeller, Edward Harriman, accumulated controlling stakes in multiple companies within the same industries. They coordinated pricing. They divided markets. The result was the trust era, Standard Oil, U.S. Steel, the railroad monopolies. Competition was suppressed, prices were fixed. The public backlash led to the Sherman Antitrust Act of 1890 and the Clayton Act of 1914. These laws made it illegal for competing companies to coordinate their behavior. But those laws were designed for a world where ownership was visible, where the men exercising control sat in boardrooms. The Big Three don't sit on boards. They don't coordinate pricing in smoke-filled rooms. They simply own. And the effect, according to economic research, may be similar. A 2018 study by economists Jose Azar, Martin Schmaltz, and Isabel Tecu examined the airline industry. They found that routes with higher common ownership concentration had ticket prices 3 to 7% higher than routes with lower concentration. Across tens of millions of passengers, that represents billions of dollars. Similar studies examined banking. Deposit interest rates were lower, and loan rates were higher in markets where banks shared common institutional owners. The mechanism isn't collusion. It's incentive alignment. If BlackRock owns major stakes in Delta, United, and American, what's BlackRock's interest? It's not for any single airline to crush the competition. That would destroy profits in its portfolio. BlackRock's interest is for all three airlines to maintain comfortable margins. To compete less aggressively, no one has to tell the executives this. They can infer it. This is what the data shows. The immediate beneficiaries are clear. Average investors gained access to diversified portfolios at near zero cost. A factory worker can now own a slice of 500 companies for an annual fee of 3 basis points. The fund companies benefited enormously. BlackRock manages $10 trillion. Even tiny fees at that scale generate massive revenues. The largest corporations benefited from guaranteed inflows. Every 401k contribution sends automatic money into the biggest names. This creates a floor under their prices. And the executive class benefited. When your largest shareholders are passive funds that almost never vote against management, your job is secure. A 2020 study found that CEO pay at companies with high passive ownership increased significantly compared to companies with active shareholders. The costs are distributed more diffusely. First, price discovery degrades. As active management shrinks, fewer analysts cover small companies. Fewer researchers dig into financial statements. The market becomes less efficient at allocating capital. Second, small companies suffer. Index funds are weighted by market cap. The biggest companies get automatic investment. Small companies receive almost nothing from the passive bid. Their cost of capital is higher. The playing field tilts toward incumbents. Third, workers and consumers in concentrated industries. If common ownership reduces competition, if airlines raise prices and banks cut deposit rates, ordinary people pay the cost. Not as investors, as customers. Fourth, future investors. The mathematical reality is that passive investors cannot collectively outperform. They are the market. The system only works if prices are set by others, by active investors doing research. But if everyone is indexing, who sets prices? We don't have historical data. We only have logic, and the logic is concerning. Here's where the structural trap becomes clear. Index funds cannot be reformed without destroying what makes them work. The entire premise of passive investing is that you don't make decisions. You buy everything. You hold forever. You don't research. This works when passive investors are a minority. They free ride on the price discovery done by active investors. But as passive strategies dominate, the free ride breaks down. There's no one left doing the work. Prices become untethered from fundamentals. Here's the trap. If you try to fix this by making index funds more active, by having them vote more aggressively, by selecting stocks, you destroy the cost advantage. But if you don't fix it, the concentration of power continues. Price discovery erodes. There are only three possible outcomes. One, passive investing continues to grow until the market becomes structurally unstable. Some shock reveals that everyone is holding the same positions and trying to exit the same door. Two, active management becomes so scarce that mispricings grow large enough to attract capital back. The market self-corrects, but only after significant distortion. Three, regulators intervene. Antitrust authorities force changes. The era of free diversification ends. None of these are painless. None of them were part of the story you were told when you opened your 401k. That's the trap. There's one more mechanism you need to understand. Index funds offer daily liquidity. You can sell whenever the market is open. This creates the impression that index funds are as liquid as cash. They are not. When you sell ETF shares, either another investor buys them or an authorized participant redeems the shares for the underlying stocks and sells them. In normal times, this works seamlessly. But if many people try to sell the same ETF at the same time, the authorized participants must sell the underlying stocks. If those stocks don't have enough buyers, the price drops. The drop triggers more selling. The arbitrage mechanism strains. In March 2020, some bond ETFs traded at discounts of 5 to 8% below the value of their holdings. The arbitrage broke. Equity ETFs held up better, but only because the Federal Reserve intervened within 2 weeks. We never got to see what happens when the selling continues. What happens when 300 million people are all doing the same thing? When the flows are unidirectional, everyone buying on the way up, everyone selling on the way down? This is what happened in October 1987. On October 19, 1987, the Dow fell 22.6% in a single day. The trigger was portfolio insurance, an automated strategy that promised protection against losses. When stocks fell, the program sold futures. Everyone was using the same strategy. When the market dropped, they all sold simultaneously. The market became a self-reinforcing feedback loop of automated selling. The protection that each investor thought they had disappeared when everyone tried to use it at the same time. The parallel should be obvious. Index funds depend on other participants behaving differently. Index investing works as long as not everyone indexes. When the assumption breaks, the strategy fails. Every system has boundary conditions, the conditions under which it works. Index investing works when active investors provide price discovery. Active management is shrinking every year. Index investing works when flows are gradual and two-directional. Baby boomers are entering retirement. For the next 2 decades, they will be selling, not buying. Index investing works when markets are liquid and arbitrage is reliable. Market structure has become increasingly fragile. Each of these conditions is under pressure because the system was designed for a world that no longer exists. The question isn't whether index funds are good or bad. The question is what happens at the boundaries. What happens when the conditions that made the strategy successful no longer hold? John Bogle himself in 2018 wrote that index funds should not become too large, that passive ownership exceeding 50% could be potentially harmful to the economy. He saw the pattern. He recognized the trap. But by then, the system had its own momentum. Systems don't reverse because they become problematic. They reverse when they break. This is historical and educational analysis. It is not financial or investment advice. Past performance does not indicate future results. You started this video knowing that index funds are a smart, cheap way to invest. You're ending it with a different understanding. Index funds were designed to be marginal participants in a market run by others. They have become the market itself. The 3 companies that manage them have accumulated more financial power than any institutions in history. The price discovery mechanism is eroding. The competitive dynamics in major industries may be changing. The liquidity assumptions may not hold under stress. None of this means disaster is imminent. It means you should understand what you own, what it represents, what it has become. History is full of systems that worked until they didn't, until the boundary conditions shifted, until everyone tried to exit at once. The question isn't if this system will be tested. It's when. This channel traces the fault lines in systems most people trust without question. The structures that fail aren't the ones we watch. They're the ones we assume will hold. You've now seen the pattern. What you do with it is up to you.